Guys, Terrence here. This is the first video of my channel. I'll be creating content on stock market, economy and politics in general. Let's get right into it. Now 2020 has been an eventful year in the stock market. We have all witnessed the most rapid plummet and recovery, and just like many other retail investors, I jumped onto the bearish hype train. I bought into an ETF ticket BBUS on the Australian Stock Exchange when the S&P was around 2500 in late March. Basically, it is a strong bearish ETF that tracks the S&P with a 250% exposure. We all know what happened next. Despite the skyrocketing unemployment rate, infection and death count, the market rallied to about 2800 on 14th of April. However reluctant I am, I have had to exit my position and take a loss of more than 25%. I still remember last Monday when the market went up by like 7% after record high unemployment claims. It physically hurts me and kept me awake all night long. Now, as an investor, we always have to learn from our mistake, and I've summarized what I've done wrong. In hindsight, I've been way too obsessed with the fundamentals. By that I'm referring to the 20 million unemployed people, the 600,000 cases of infection in the US, and the remaining 1.4 million people around the world. My decision to go short was simply driven by basic economics and global news on the pandemic, without truly understanding the sentiment of the price action. Now we all know that the corporate earnings will be disgusting for the quarters if not years to come. We all know that the economy and stock market will crash in one point in time, when people realize the Federal Reserve cannot save the day. But I seem to have disregarded the classic quote by Keynes: "The market can remain irrational longer than you remain solvent." Trading or investing is a war, not a battle. However confident we are about the collapse of the market, do not go all in. Fundamentals always tell us what will happen, but it doesn't tell us when will it happen. Stay rational and acknowledge that the market isn't. Now, despite the painful loss, I'm still a bearish investor. I don't see much upside potential but very significant downside risk. As far as I'm concerned, the following issues have not been priced into the current market value. First, the speed in which the economy will recover to business as usual. There has been unofficial rumors saying that the economy will progressively reopen in May and that will result in a V-shaped bounce. It just sounds total nonsense to me. As of today's 17th of April, there are 22 million American citizens filed for unemployment benefits, without mentioning the horrific speed of it increasing by about 5 million per week. Now, do you think these people will be hired as soon as the economy reopens in May? I would say some may, but most of them would not, because a lot of small to medium businesses would have gone bankrupt by then. And if these people do not have an income, they won't come out and consume, and it will further drive the GDP down and forms a recession or even depression if it prolongs. Let's look at the first quarter GDP of China for some insight. They reported a 6.8% contraction, which is the first one in decades, as compared to a 6.6% increase in 2019. Bear in mind that the Chinese economic data has always been accused for its transparency and accuracy. The actual figure could be severely lower. What does that say? That means even if the outbreak is over, the economic hardship is likely to continue. Second, the risk of continuous lockdown in developing countries are not priced in. If we look at the tracker, we can easily identify some developing countries that have been severely impacted by the virus. As we have a highly integrated supply chain, hiccups in these countries could result in delays in production and ultimately loss of business. Bear in mind the actual numbers in these countries could be substantially higher than what has been reported, due to high density of population and the limited medical resources available. For the past few weeks, I've seen very little media coverage on these countries. Neglecting the developing countries could lead to a dangerous delusion that the world could return to normal once Europe and America gets the situation under control. I really think the developing countries have been overlooked by media and us investors. Lastly, the stimulus package could result in a disastrous debt crisis, just like the GFC in 2008. Central banks around the world have been pumping out trillions of dollars into the economy, which is kinda necessary to counter the virus. If we look at the US, the debt has now surpassed $24 trillion and is heading to the $30 trillion mark if we take into account the upcoming actions from the relief program. To put the number into perspective, it is equivalent to 111% of the GDP, over $73,000 per person, and over $188,000 per household. If the virus prolongs, companies who just received the loan, for example Delta Airline, who will get $5.4 billion in aid, will not have the money to service the debt, which leads to loan default. Wait till the bullish sentiment cool down and the market will realize how fragile our economy is and how the stimulus package is merely delaying the pain without solving the actual problem. All in all, I would not buy into the idea of a V-shaped recovery. I'm still very skeptical and I'm waiting for the second crash. Now let's look at the game plan. While I'm fundamentally bearish, I'm not gonna go head to head against Trump and the Fed, at least not for now. The US cannot afford another crash shortly and Trump will make sure it doesn't happen. My tactic is to take a break and go heavy in cash. Right now I'm sitting on 65% cash and would like to make it 80% shortly. Before going back into my short position, it would be ideal to see some signals from the market. In particular, I'm looking for strong resistance at the 2850 or 3000 level, ideally confirmed by a double or triple top pattern. If that happens, I'll go right back into my strong bearish ETF, with the price target being 2650 and 2220. If the S&P goes below 2220, which was what we had in March, I will start picking up some good stocks for long-term investment. It really depends on the circumstances. I don't think the crash will come too soon and we will have to be patient. The market has been digesting information in a rather confusing way. It appears completely detached from the economic reality and makes me wonder if I'm investing in a parallel universe. So for the time being, I'll just take a break, stand on the sideline, stay cash heavy while looking for market signal to enter. Last word to my fellow bearish investors. Yes, we did have very difficult weeks, but please hang in there. The stock price will eventually reflect the fair value of the company. Do not lose faith in fundamentals and, more importantly, in yourself as an investor. Stay rational and stay healthy. Now, if you liked my first ever video on YouTube, please give me a thumbs up and subscribe to my channel. That would really encourage me to create more content.